Hi traders, welcome to this week's edition of Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just briefly run through what we hope to get through for the next 45 minutes or so, hopefully. Firstly, we'll just check out how markets are shaping up this week. We'll actually look at a broader theme that we quite like and is sort of an interesting one, we think, to sort of think about the markets at the moment, as well as then we'll check out, as usual, stocks and have some observations on the earnings season, which ramps up for sure this week. We'll then look at a quick overview of the most recent important events. They are the Bank of Japan meeting for sure, and also some of the UK data last week, a big data dump mid-month as usual in the UK. So potentially some interesting drivers for cable there that we have seen sterling strength over the last few days, certainly. And then we'll look at this week's events, the Bank of Canada meeting, some US data, and also hopefully we'll get into Eurozone PMIs and the euro in general. All the while, of course, we'll look at the currencies associated with those risk events. So dollar yen, of course, cables, sterling against the dollar. We'll look at dollar CAD, of course, for the Bank of Canada meeting. And we'll have a brief look at the DXY as well. And then also euro dollar, hopefully, as I say, wrapping things up. So this week, really starting off with, well, the dollar gently offered, actually, but the euro certainly pushing up to new highs, levels we've not seen since May 2020. Above 109, so interesting move, interesting potential breakout there for euro dollar. Whether it's a proper breakout or a fake out even, we shall see, and we'll look at that technically shortly. Otherwise, trading conditions certainly in Asia overnight have been quite quiet as China starts a week of public holidays. For the Lunar New Year, that is, of course. Market hours then in Asia will be limited this week. Means light volumes are expected, and moves could be actually amplified really in thin trade in those hours, certainly. China's market, just to inform you, is shut all week, so that's Monday to Friday. Hong Kong's market is shut from Monday to Wednesday. Singapore's closed Monday and Tuesday, and actually the Australian market is also closed on Thursday for Australia Day. Quick review of asset market performance year to date really shows equities performing really well. European and Chinese equities certainly leading the pack, up around 7-8%. Bond markets also been performing well, and those have then been led by emerging market local currency sector. In the FX space, you can see here, this is year-to-date performance. The currencies most affected, most impacted really by the China COVID U-turn in that policy, really relaxation of those restrictions, of course, really helping the Aussie dollar, the Kiwi dollar, certainly those in the top three best performing major currencies. Sterling, of course, also getting a lift from, as I mentioned, that data last week, and we'll look at that in more detail soon. And then bottom of the pile, we have the dollar, of course, which we'll talk about. So this week we have US fourth quarter GDP data. We also have those European PMIs. And then the Bank of Canada rate decision on Wednesday. We also get some CPI data out of Australia and New Zealand. All be watched if you're trading or should be trading potentially those currencies and those risk events around those currencies. I mentioned a broad theme at the moment around the global economic cycle. It's kind of at a critical juncture in a way. We say that, or some people say that often, but really it's interesting that investors are trying to now obviously weigh up the options between whether we get this soft landing or a harder landing, if you like, and a recession, really. And certainly markets veer between those sort of two different phases that potentially we come into now, and obviously hopes that we get a soft landing. The Fed really threads that needle that we've been talking about over the last few weeks, and manages to engineer really, whilst obviously with this aggressive rate cycle, then producing some sort of softish landing, bringing demand back and reining it in really, so that we get or we don't get a harder landing. US data certainly recently has been quite weak. Housing data, that's been weak for months now, and it is really the real economic data that is now starting to show really quite a significant deterioration in the US. And markets really are evolving on their interpretation of that economic data. So we're coming from a point really where, if you think about it, bad news in the economic data was actually good news for markets. That suggested the Fed would pivot on its rate hike cycle, and that provided a bid to risk markets, to equities. But now we've kind of shifted towards bad news in that economic data being bad news, if that makes sense. In markets, we've been talking about this. If you sit on trading desks, we've been talking about this for years, really. If we trade fixed income markets, especially, it's kind of good news, bad news, and that's type of a theme. But interesting now, it's sort of made its way into this sort of area of economic data. We've talked about it in our daily commentaries as well, so that now we're at the point where bad news is bad news, because it's starting to sort of send concerns to markets about what the Fed's tightening cycle may mean for the outlook for growth going forward. And that shift in perspective certainly came sort of highlighted on the back of a weak set of data last week. We had retail sales fallen now by 1% or more for the past 2 months, and industrial production has now fallen for the past 3. So really sort of concerns, especially on the US retail sales, about the health of the US consumer, obviously a key driver of the US markets. And of course, then that potentially there's all that focus around the jobs market and potentially higher unemployment, then affecting certainly the US consumer going forward. That said, we also had on the flip side, in a way, we had lower PPI data. We had a big downside surprise. You can see on this chart here, the light blue line being the PPI data. So that's the producer price index, which goes into obviously making goods. And that's really sort of the first line in inflation potentially. And you can see that we've moved sharply lower, and then that points potentially to big falls in US CPI going forward. So that's obviously something to offset really this these softer numbers in some of the consumer activity, in some of that data, as well as industrial production that I've mentioned. We also had a 4-month low actually in weekly initial jobless claims data. That's a sort of more frequent employment numbers. And then we also had sort of several high profile announcements of job cuts by the likes of obviously Microsoft and Alphabet, Google's parent. So really sort of interesting, this, as I mentioned, this sort of good news is bad news, whether that continues or not. That theme be interesting, and we're looking out for that going forward. As far as equities go, we still, last week, certainly the US blue chips, they ended last week lower, all told, after that mixed data that we saw, and also then central bankers, especially in the Fed, who are continuing to reiterate their commitment to fighting inflation. That means obviously more rate hikes going forward. Again, and certainly then it's sort of made for a choppy week in risk markets, in equities. As I said, the S&P 500, that added 1.9% on Friday, but it still shed 0.7% in the week. And that week, if you remember, had 4 trading sessions due to the Martin Luther King holiday on Monday. Even then, it just sort of highlights the choppiness in markets, where the markets are sort of undecided as to this soft hard landing. And then we have also those Fed speakers adding to the mix. The tech-heavy NASDAQ, that rose 2.9% on Friday, actually, for a gain of 0.7% on the week. And as I've mentioned, we're really getting into the fourth quarter earnings season now. That really picks up with key earnings from Microsoft this week, from Tesla, from ASML, chip maker, Visa, Chevron, IBM. So it'd be interesting with these results hitting markets, hitting the wires as well. The aggregate earnings surprise for S&P 500 companies that have reported earnings is currently just above 4%. And the market has generally responded positively to Q4 earnings reported so far, with, for example, say the Netflix 8.5% jump on Friday, really highlighting, well, it is strong outlook for its advertising business, but that being the clearest evidence. And then regarding S&P 500 tech companies, then they make up 26% of the market, and its expectations are for them to report a quarterly profit drop of around 9% on average, according to Bloomberg. This could be the biggest then tech profit drop since 2016. A forward 12-month earnings of 39% is also expected, according to Bloomberg. So the possible danger really is that estimates potentially actually too bullish still, and that markets likely be disappointed and then trigger a fall. Overall, aggregate S&P 500 earnings expected to have grown just above 2% in the quarter. Most growth will come from commodities, miners, the least growth from real estate. But so far, actually, only 55 companies are reporting the S&P 500, and earnings have fallen over 4% on average. So the sort of case, really bear case, is still a factor for many investors, especially in tech. And potentially then more job cuts. They're expected, with margins being squeezed. As I say, this week, main focus probably on Microsoft, Tesla. Microsoft is after the bell on Tuesday, Tesla after the bell, I think, on Wednesday, as well as IBM. So there'll be a focus for markets. I wanted to just probably, we'll go to some of just look at some of the charts actually initially. So just looking at the S&P on a technical basis, then having looked at earnings, well, we're still toying with this key resistance zone, the 4,000 level, key psychological level, of course. You also have that 200-day moving average just below there, 3968, and then obviously this long-term trendline resistance just around 4,000, sort of coincidentally, but really key level then, key resistance level. If we can push higher, then the 4,100 December pivot highs are near. And then we have support below, probably the 50-day moving average, that's at 3928. And then we have this longer term fib level that you can see around 3815. So you can see really just looking at the weekly chart, actually, that the strength of that trend line resistance, really the push above there, will get us towards those, as I say, those pivot highs in December around 4,100 potentially. And then above there, you can see, well, the 100-week moving average at 4,200 potentially. Otherwise, we sink back down to last week's low at 38.85 and then 38.15, as I've said, that long-term fib level. For the NASDAQ, technically, you can see us just above now. That's a 200-week moving average at 11,542. So we closed above there on the week, but we're still, if we look just below that long-term trend line resistance, which comes in probably around, where are we? Well, bang on really where we are now. So around 11,620 probably. This is an NASDAQ 100. If we do get above there, then we do have this fib level around 11. Where are we? 768 or so. That's the halfway point of the big move actually from the pandemic low up to that high in November of last year. So 11,768 really potential upside, which really resistance really, which is also then that trend line resistance. The Dow, just looking at that briefly, again worth looking at the weekly. You can see that level we pointed out quite some time, that resistance level at 34,281. We closed obviously below there last week. And you have support at the halfway point of, the near-term move, which is at 32,834. Interestingly, the Dow is now lagging. I think we highlighted this a few weeks ago, actually, about that a couple of months ago now, about the outperformance actually of old economy cyclical stocks and tech stocks lagging, and that's kind of slightly switched this last week even. So you've got sort of underperformance now in the Dow as techs moderately really outperform. We have looked at the DAX recently. Interesting now, just pulling up that chart. We still got sort of outperformance then of European stocks above and outperforming US stocks. We're sort of just come off the recent highs there, just above 15,200 in the DAX. Slightly overbought, you can see on the daily. So healthy pullback really. And as long as we sort of stay above probably this point here for 14,677, so a few hundred points, but near-term support probably at last week's low 14,901 there. If we can consolidate above there, then bullish momentum potentially points us to, again, new highs. We would, as we've mentioned, highlight, just bear with me, the outperformance of European stocks. You can see here since the start of the year, light blue line is the Euro Stoxx 600. So benchmark index for all the stocks, the main biggest companies in Europe. And then that contrast, you can see NASDAQ outperforming the S&P 500. And if we had the Dow, that would be a touch lower, I think. So yeah, you can see whether then that's been a theme, certainly. And whether that continues. Obviously gas prices lower, easing pressure from the ECB, although they're still in hiking mode, and we're going into that later hopefully. And then obviously the China relaxation, China being Eurozone's biggest trading partner, and really that's been a big boost to European equities. Interesting whether that will continue. Okay, let's next look at the last week's couple of risk events, really, or a few risk events in the UK, but certainly the Bank of Japan meeting. If I just go to the dollar-yen chart firstly, which you can see here. But the Bank of Japan meeting, certainly the Bank of Japan's decision to leave its policies tools unchanged clearly disappointed FX markets. They were positioned for further adjustment, really, further changes after that surprise December move, tweaking the yield curve control policy, if you remember, widening the bands. Arguably then the market got ahead of itself, where, we could see the run-up actually in some of the 2-year yen, so the 2-year yen interest rates, swap rates, really, they jumped up to 0.3%, suggesting even that a rate hike might be on the cards in the not too distant future. And now those swap rates, they've dropped back to, half, around 0.15% really. And that's taken the yen with them. So the yen has sold off, dollar yen has moved higher. The Bank of Japan also released their latest forecast for economic activity and prices. So it trimmed its GDP outlook And then in the case of CPI, it forecasts slightly raised forecast for this year. But then the 2023 forecast remained unchanged at 1.6%. And really then the new sets of forecasts, they indicate that the Bank of Japan really will continue to pursue its 2% sustainable target, as you kind of think the recent higher than usual CPI data is only what they think is transitory, actually, and will soon be past the peak then. Despite, of course, the inflation elsewhere that we're seeing across the developed world, which is certainly coming down. So interesting position for the Bank of Japan. Most economists who watch the Bank of Japan very closely, they think risks to growth are actually skewed to the downside then, based on recent weak activity and forward-looking data. So then the bank believes that the economy is really not ready for a reduction in stimulus. That, of course, means it's kept its rate and yield curve control policy unchanged. Probably wanted to kind of convey the message that the Bank of Japan is obviously standing pat. Don't fight the Bank of Japan, I think one investment bank put it. So interesting, real sort of shift from, obviously slight shift from the December meeting that tweak, although the Bank of Japan obviously just stated that that was just to get the bond market functioning better. It wasn't any kind of sign of policy normalization. We'll see what happens in the future, of course. But for the moment, with, of course, the evolving global backdrop and having held firm in January, then it's kind of difficult to see the Bank of Japan making another change before the Governor Kuroda, of course, steps down in April. That then, of course, keeps this historic divergence between rates in Japan and the rest of the developed world, keeps that divergence intact. And in fact, as I mentioned, those forecasts for CPI further out, actually 2020, well, next year, but 2024 as well, could potentially make the case for the new Bank of Japan governor in April, continuing with the current ultra loose policy. That's, of course, their forecast for the time being. For dollar yen, then the decision kind of to leave those policy tools unchanged saw the major really price or kept up its pricing as one of the most volatile pairs in the G10 space. Potentially that continues as we move forward, certainly just addressing the new Bank of Japan governor. We get the new nominee's name presented to Parliament, I think in February. And then that's a sort of March, April window when Governor Kuroda will then hand over the reins to the new governor and the governing board. Just looking at dollar yen, then potentially, of course, if you look on the dollar side, weakness as the Federal Reserve, obviously, their easing expectations potentially build into the second quarter, especially if then we see US core inflation falling more quickly. Dollar yen, then that would mean that comes under pressure from the dollar side. And then, well, we've mentioned sort of one side of the yen potentially keeping its the Bank of Japan keeping its dovish policies. But if then that changes, which is obviously what many expect as well, we get that policy shift potentially in April, then that potentially then limits the upside in dollar yen. So correction wise, obviously we've got a base here. You can see technically on dollar yen, 128.16. That's a long-term fib level. You can see there the major fan support there that you can see sort of tracking along that. Then you can see that big jump in this candle here on the Bank of Japan, disappointing many, but then we did pull back and close, well, still higher on the day, but much nearer its lows, and that looked quite bearish really to us. But We've seen a bounce off that fib level then, 128.16. We're still in this long-term sort of bear channel that you can see potentially towards the sort of top of that bear channel, which comes in around 131 or so. So that'll be interesting whether we can push above that. And then the next level would be the halfway point, 50% marker at 132.70 potentially as next resistance if we do come out of this sort of bear channel. Otherwise, then, if we do roll over, obviously 128.16, and then the low of this move, 127.21, many people looking to 125 and below, actually, if then we do roll over as we get towards sort of April and speculation around the new governor, potentially then reining in some of those dovish policies. We shall see. Okay, over to just looking briefly at the UK data. Most important was last week was the December CPI figures, the inflation data that was released on Wednesday, largely matched consensus expectations. You can see on the chart here, headline inflation decelerated from 10.7% to 10.5%, while the core rate held at 6.3%, unchanged from November, but above expectations for a modest drop to 6.2%. We've got that here, the lighter line, the core CPI, and then you can see the headline number there just coming off its highs, but remaining still elevated. So is the peak still is the peak in? Most economists, most UK economists who are looking at the inflation data really see that we're now past that peak, and we could see headline inflation going forward, probably potentially returning to, well, around 6% in the summer, and then lower than that by year end, around 4%. But certainly in the near term, numbers really still in double digits, and if you think about it, they're more than 5 times the Bank of England's inflation target of 2%. It's also important, if you dig deeper into these numbers, to note that the core services inflation number that jumped from 6.4% to 6.8%, and that development will certainly get the attention of the MPC at the Bank of England, who will take that certainly into consideration when weighing up their policy decision in well, next week actually. The other main data in the UK, just to touch upon that, the labour market data, that was decent as well. For November, showed unemployment remaining unchanged at 3.7%. Jobs rose 27,000 against expectations of zero growth. And then average weekly earnings, key for policymakers, that rose 6.4% against forecasts of 6.3%, and up actually from 6.1% in October. So this real upside surprise in wage growth, which is rising at a near record clip, in fact, kind of leaves the Bank of England with little room for maneuver on its rate decision next week, next Thursday, that is, February 2nd. Markets pricing around 46 basis points of tightening, so a half point rate hike is expected. That's up marginally from or over the last week, obviously with that data pushing the odds of a 50 basis point hike really pretty much nailed on now, and that's given sterling a decent lift actually. In fact, the year's gains we saw on the chart there better now than the euro year to date in sterling over the euro. And certainly we have to remember, going back to sort of September, we've had a marked improvement in the perception of UK sovereign risk, and that's been key, obviously, just this stabilization we talked about last week, actually sterling taking a back seat, and that was kind of what was needed after those sort of autumn turbulence, if you like, and more, and sterling performing quite well, holding up well. This week on the UK calendar, we just get the January PMI readings. Again, both manufacturing and services components expected to be in recessionary territory. And as far as sterling goes against the dollar, cable, that is, of course, we've sort of pushed up. If you remember, we highlighted the sharp rebound from those last week's lows or previous week's lows, actually below sort of 119, 118. Where do we get to? 118.73, 118.41. But then we had this sort of bullish engulfing candle, positive, strong close, and then we've sort of tracked sideways with a sort of more bullish tilt to it. But you can see that we're struggling still to break 124, to break those mid-December highs at 124.46. That tallies with the fib level there, 124.52 as well. Where do we get to today? 124.47, and then we sort of come back lower. So sort of big, real, quite a major resistance sort of zone building there. You can see at 124.50 or so. So interesting whether we can actually push above that or not. Support then probably goes down to sort of 121 area or so in cable. Okay, moving on now to the dollar. Lots of focus certainly on next week's Fed meeting. I mentioned the Bank of England meeting just to highlight actually next week's events. We also have the ECB meeting on a Thursday, along with that Bank of England meeting, Fed meeting the evening before UK time. So three major meetings again in the space of probably 20 hours or so less. And then we get also some mega cap tech earnings as well. Apple and Amazon reporting, I think, next week. So major risk events next week to look forward to. In the near term, the US focus will be on some of those PMI readings where both manufacturing and services sentiment are expected to continue with recessionary sub 50 levels. Remember, 50 denotes above 50 sub 50, sorry, contraction. Above 50 would be expansion. We're expecting to see sub 50 levels for those US PMI readings. And then Thursday, we should see, fourth quarter US GDP actually being reasonably strong, figures of around 2.8% quarter on quarter. Although that strength may be driven by the trade side on the back of weak US imports. But the consensus view, yes, is, actually more pessimistic now than the Atlanta Fed's GDP now forecast. That is tracking growth at around 3.5%. But remember, of course, GDP is a lagging indicator. And certainly many economists going forward think the growth dynamic will worsen significantly in the US. And this is, of course, what we've been saying at the sort of top of the webinar. Friday, then, we see the December personal income data. That includes the Fed's preferred measure of inflation, the core PCE deflator. That should support really the narrative that US inflation risk or the threat actually is easing. And there's been a broad deceleration in core goods and services, with the main upward pressure on core PCE being from shelter. And that's likely to show sort of stubbornly high inflation for at least the first half of this year before then turning lower. And we've certainly talked about that over the last few months. It's also worth noting that this data, of course, will be released during the Fed's blackout window. That is, of course, when we don't hear from any Fed speakers. They're not really allowed to speak ahead of the Fed meeting next week. Obviously, we've had a load of speakers last week and before that, really sort of highlighting how they're determined to carry on hiking. Interestingly, I think late Friday, we had Waller, Fed's Waller, who's known as a hawk, but sort of highlighted that they probably move to a 25 basis point hike next week, which is nailed on now. And especially after that weak data that we saw last week, the odds of a 25 basis point hike have ramped up now. Caveat, of course, is around income and data, and potentially if we do get a sort of upside surprise in the PCE data on Friday, then perhaps we move to a 50 basis point or closer to a 50 basis point hike. But at the moment, 25 is pretty much nailed on. DXY then, obviously, it's come a long way already. And probably potentially then the market really doesn't add to its shorts unless, as we said, we get sort of data surprise. So probably the market doesn't add to its shorts in dollar positions ahead of the Fed meeting next week. We can see then in the DXY, which is obviously a dollar index made up of 6 of its major trading partners, euro being obviously the big weighting in the DXY, then sterling and yen much lower, but around 11-12% sterling and yen. The euro makes up around 56%, I think, from memory, 57% or so in the DXY. So you can see sort of trying to hold on to some sort of support. We've got a lot of lines here, but just pulling back, you can see the zone that we've sort of highlighted for a long time around 103, which we broke lower, and then we've sort of got a couple of fib levels. Probably 101.99 is the big one. That's from the dollar's rally, and that's the halfway point of the move from sort of 2021 lows up to the highs last year. So 102 is the halfway point of that rally. And we're pretty much just above there. You can see 102.03 now. So critical level, we'd say here. And then we have the most recent low at 101.52, potentially if we do move lower. But the calendar, well, this week at least should probably keep the dollar on the soft side. As we say, it's come a long way, the DXY, and potentially then sort of a lot of eyes on the Fed next week. Okay, now just looking at the Bank of Canada decision. So they're meeting on Wednesday. Most watchers think the central bank is on the cusp of downshifting the pace of its hikes, with many now expecting a 25 basis point move on Wednesday. That said, the central bank has kept its policy options open, meaning that an unchanged outcome possible, or even 50 basis points, maybe. But I think market's siding towards 25 basis point move. Interestingly, after lifting its the rate by 50 basis points in December to 4.5%, the BOC basically said it will be considering whether the policy interest rate needs to rise further as it continues to assess how tighter monetary policy is working. And they also added that and how inflation and inflation expectations are responding. So regarding recent data, that's kind of been sort of mixed, close to neutral. We've seen some slowing on the activity side, especially forward-looking data. But then underlying inflation is uncomfortably high. Inflation expectations, they remain elevated. And certainly the labor market is still very tight. So probably means that in this environment, not really the kind of one where data has softened enough to warrant a pause just yet, and nor has it been strong enough actually to continue with 50 basis point clips. And in fact, actually, Governor Macklem last month, even he remarked that elevated inflation means that the Bank of Canada had to be more concerned about under-tightening. But yes, certainly. So going forward, if the Bank of Canada's rate hike that we do see is potentially the last of the cycle, then the question potentially is how the bank communicates that. Certainly, they probably want to retain optionality, which it has done in its communications, really, and then will use the January statement, actually similar language to the December version, potentially. That means it makes it clear that it could be the last hike, but it's not committing to it. And then it leaves the data to determine the near-term rate path. Of course, any changes to that kind of view, more forceful sort of potential outlook, then means the Canadian dollar would be bought, and then vice versa. If we see a firmer sort of statement around saying it's a pause, potentially their work is done, then obviously the Canadian dollar will sell off. We can see on the chart then, well, one thing to point out actually before we do look at the chart, this is the dollar CAD chart, of course, to highlight really the loonies relationship actually with the S&P 500, which still remains highly relevant. Of course, when we think about the loonie, we think of oil prices. Certainly, it's got a high correlation to that, but as well, Canadian dollar is certainly related to risk sentiment, to equity correlations. And even though that's kind of weakened slightly in the past few weeks, I think there's still definitely a strong positive correlation of daily returns in US equities to the US, the S&P 500. I think that's around 60% currently, one Canadian investment bank, according to their studies. So really still the strongest among the major currencies, and we shouldn't forget that. So as well as oil, risk sentiment, strong correlation with the loonie, and a big driver of it. So technically then, interesting really, we've sort of got those sort of trend lines top side and on the underside as well, sort of compression slightly. But then you've really had sort of little appetite recently anyway for dollar CAD to move either way. And you can see we're sort of trapped. We've called it sort of 133, 135 level there, and then we sort of were oscillating as well sort of during December between 135 and sort of 137 just below. So sort of no appetite at the moment anyway to move it, to move the major anyway, move strongly either way. Support we've got at 133.52, that's sort of a near-term fib level. And then we've got resistance at the 38.2 fib level at 135 there, and that corresponds with some of those moving averages, 50-day moving average and the 100-day moving average as well. If we move lower, then very near-term trend line support then around that 133.50 area, break down below that, then potentially we go down to 132, which is, the spike high you can see there from mid-July. And then we've also got a fib level and the 200-day moving average, at just below 132, 131.90. So that's dollar CAD. Briefly, let's just touch on the euro, because obviously it's hit the highs recently. We've talked about European stocks. That's been a driver of the euro. Demand for the euro, of course, as stock markets in Europe have outperformed the US. Certainly, that's been on the back of course, softening gas prices, certainly, and then also of course, we have the dollar outlooks weakening, and then that China COVID U-turn. Interestingly, for euro dollar specifically, there was some emphasis really on last week. There was a story on Tuesday, I think it was, ECB sources story. If many of you trade the euro dollar a lot, then you will be accustomed to these sources stories that come out from time to time. The market does pay attention to them. That story really highlighted the prospect of a downshift to 25 basis point hike in March, and then that would be after the 50 basis point hike in February. So we did sell off relatively softly, you can see here. And as sort of there was some uncertainty as well as to whether that would be the case. But we have to think that that story at least went against a lot of what we've been hearing since the December policy meeting, and really since a number of ECB officials have come out signaling that there would be certainly 2 50 basis point hikes next week in February, and then the meeting later in March as well. So We can see sort of euro dollar shaking that off. I think Friday we had President Lagarde actually saying still more work to be done, I think, pretty much. And then we've had other speakers as well, really pretty much saying similar, being hawkish. Lagarde, sorry, I think she said that the central bank had to stay the course in their fight against inflation. And that comes on the back of other comments actually on Friday. Villeroy, ECB's officials, these are Villeroy and Knott as well, pushing back against that idea of a downshift. And Eurodollars sort of responded to that in the last few sessions at least. As I say, we've got up to levels there, although come off that interestingly. 109.26, the high from today. And it's then really markets looking towards the ECB meeting next Thursday. Between then, we have those PMI services data tomorrow, which are generally, sorry, just bear with me while I just catch up on Eurodollar, actually the chart. But sorry, yes, data-wise, we have the PMI data tomorrow, potentially. And then we have also, sorry, the German IFO index, that's the business climate index on Wednesday. So I was just checking the calendar when that was. That's on Wednesday. Interesting to see whether that's, or the expectations component, where that picks up anywhere near as sharply as the other German investor survey. That's a ZEW survey. And then we get those PMI releases tomorrow. If they surprise to the upside, then that could give policymakers confidence really to proceed with the more aggressive path for rates and really dispel that speculation around the ECB stepping down to a 25 basis point hike in March. Okay, so technically, yes, we have, sorry, just finally, we have, yeah, upside sort of resistance at 109.42 sort of corresponds with that DXY level. If you remember, you flip the chart on its head, you get the DXY or Eurodollar. So 109.42 is an upside resistance level there. 109 probably the barrier so far. You'd like to sort of probably think. And then support. If we do drop, then we've got sort of this 108 support with last week's low at 107.66, so near-term support. So if we do oscillate around here again, you kind of think that's bullish consolidation. But if we do break below sort of 107.66 last week's low, then potentially we move down towards here, 107.36, and then below that. Okay, no questions. Please do ask questions if you do have any, whatever it is, we would like to answer it. But otherwise, we'll speak to you next week. Please do follow us on social media, and we look forward to seeing you then. Good luck out there.